what I want to cover was really just talk about investors, right? You've started your business, you're looking to start a business, right? You have the idea, you have the passion behind it, but how do you fund it going forward? Right? As you know, and as you look to investors, right, they provide money, but that's sort of the obvious piece of it. Additionally, really, they can provide a lot of other things to help accelerate your brand both today and a long time into the future. Right? They're able to come with funds, but they also come with a network. They have relationships both within the drinks industry, outside of the industry, that can help you both grow your business, build better contacts, as well as look for future investors. They also have expertise and knowledge, right? They've been around, whether it's a group of people from an investment fund, a wealthy individual that started their own business, they can bring experience and knowledge that can really help you avoid some of the pitfalls that they did. Also, they have an objective view, right? You have the passion, you're thinking about growing your business, you have a desire to get there, you've gone through, you've broken down walls, you've continued to grow your business. They can help provide sort of an objective view to really make sure that you're thinking about all the right things as you grow. But also, they'll have opinions, right? They'll have opinions on how you should grow your business, what you should be thinking about. So you do want to make sure that you have, right, the right investors that align to what you really want to do, both you, your company, and your vision for the brand. They also have expectations, especially when you look at financial investors. They are going to want to make a return, right? They are going to see how you're growing your business. They're going to want to make sure that you hit the targets that you talked about, that you forecasted when you went out to raise money, and they're looking for returns. And depending on who they are, they're going to look to figure out where you exit. So who do you eventually sell to in the long term? Also, they can be friends and partners, right? Starting up a business, growing a business, getting it off the ground and growing it, right, is very emotional. It's a roller coaster that you go through. They can be great friends and great supporters as you go through it. And also, depending on your type of investor, they also can provide broader access. If they are strategics, they can give you a distribution relationship. They have relationships with producers. They could do it themselves. They also have marketing and a whole bunch of other things that you wouldn't expect when you look at getting a brand and a partner. So if you look at it, right, selecting an investor is one of the most important things you can do to think about growing and the future of your brand. This graphic right here is really just supposed to simplify and give you an idea to think about your business as you continue to grow along its path. Right? Starting off, right, it's right as you get going. It's pre-revenue, it's an idea, it's finally coming to life. You're probably doing everything yourself in terms of growing your drinks business. Right, you're just out there in market, you have a concept that's finally there, and you're just getting things moving. Right at this point in time, it's really early stage investors. They're betting on you, they're betting on an idea. There's not a lot of sales, not a financial or commercial performance that's supporting it. Then you'll continue to grow your business. You're becoming more of an established organization. You're starting to grow your team. If this was a part-time job, it has become full-time now. You're growing in your own market. You're looking to expand in additional markets, and you're actually seeing both strong financial and commercial growth. These investors are still looking at you, they're looking at your team and the idea, but they're also starting to see how you're performing in market. And then the next is positive EBITDA, or just positive profit. You're continuing to grow, you've established yourself in your current market, you've been able to grow into additional markets, you're starting to become a real established business. At this point in time, right, it's still you, it's still your team, but there's a lot more that's there in terms of the whole organization that's starting to grow. And then there's your future. Not really getting into that, but as you continue to grow, you can remain independent. You could look to sell your business on to someone else, or you could even, for some larger companies, look at IPO. And then you have different investor profiles below. We'll sort of walk through those in detail, except for sort of the crowdfunding option. But each of them look at you differently. They have different objectives, both in your early stages as well as when you grow up. The first is individual investors. These are friends, these are family, wealthy individuals. They're sort of who you go to first to be able to fund your business, right? They love you, they love the idea, they've probably heard you talk about it for years, and they're really proud to be with you on that journey, right? They're great supporters. If you look at what they do bring to the table, they know you, right? They've been around, they understand what you're doing, they support you and the idea, right? There's very little diligence that they're going to do in terms of investing in your company. One, because of the size of it, but two, right, they've been around and they understand what you're looking to do. Also can get quickly funded because of these relationships. And they can be long-term investors, right? They're going to stick with you and be with you for that long haul. What you do need to consider here is, right, they'll be small checks as well as multiple investors that you have. So you're going to have to both manage them at the beginning as well as they have opinions and they look to, right, as they continue to expand, as you continue to expand, they will want to have a seat at the table and have opinions. They'll also have different views when you look at, right, exiting and their financial needs. Some of the things just basic that you'll want to think about with regards to your business is your shareholders agreement. So do you make sure that you have the right voting rights, that people know how to make decisions, that you can still run your business? Secondly, you need to set your value. Understand how you're worth today, how you're worth in the future, so you're getting the right shareholders. But overall, individual investors are a great way to get started. They're a great way to continue to fund the business if you're looking for someone to be there for the long term. Second are institutional investors, right? These are angel investors or incubators that are independent, sort of at the earlier stages. This is venture capital groups that are coming in to invest in brands that have proven themselves, that are continuing to grow in market. And then there's private equity firms that are looking for sort of later stage companies that are profitable. These are all looking to invest in both you. They believe in the spirits category, the overall growth there, but they are looking for above market returns. So they are financial investors. The benefits they do provide is they are professionals. They've invested in similar categories or the same category. They know what to look for in brands. They can talk to you about the financial performance as well as what's happening in the industry. They have expertise and a network to really help you accelerate your growth because that benefits all of you. They can provide growth capital, which is really there to accelerate your business, but also in later stages, they can provide liquidity. And that means you actually can sell some of your shares, recoup some of the investment for all of your hard-earned work, as well as some of your investors can as well. So they're a great sort of partner if you're looking at really accelerating your business and bringing in expertise. What you need to consider is that they are going to get into details around your business. They're going to want to get into the diligence. They're going to want to see your financial performance, your forecasts. So they will get into the business and understand all the different components to make sure that it is a sound investment. And they have performance expectations. They are looking for a return. They are looking for growth. And they're skilled negotiators. So you want to make sure that you have the right sort of partners as you go through those conversations to make sure that you are getting the right deal. And they also have exit expectations. So they are looking to make money, whether you're selling on from an angel investor into a VC or beyond, but they do have expectations that there will be some type of transaction in the future. And lastly, you have strategic investors. Like my former company, Diageo, and many of the larger companies out there, they're really looking to invest in and get brands that will be a future part of their portfolio. Whether you come in early through an incubator program like Distill Ventures, later stage like ZX Ventures with the CVC, or you look at full sales, these are all strategic investors that are looking to build their portfolio and continue to grow and expand it through the access and distribution they have. The benefits that you have here is there's going to be no one else, no other partner that can provide you the level of expertise and detail just because of the overall network that these strategics have. They're also going to pay a premium because of what you can provide and what they're going to be able to do with the brand once it sort of enters their system. As with before, with the financial investors, they will give you growth capital. They'll also give you some liquidity, whether it's within the earlier stages or if you're looking to sell all or part of your business in the future. And obviously, the integration is a big benefit if you think about the ability to accelerate, depending on the way you look at marketing, distribution, and production. The considerations is that if you get in early, you're committing to a single buyer. There's generally terms or contracts that mean you have to commit to and think about a long-term relationship with these strategics. There's prearranged value and exit criteria, so you really are making that decision very early in your process. And also, you have to think about the impact to your organization. You've built a company. If you do sell it, there are the potential impacts to your organization as you look to integrate it. And then also, there are ways to continue to be involved even post an acquisition, whether it's marketing, whether it's production, whether it's still being the face and the founder of the brand. There's many different options that you want to consider as you look to talking with a strategic. So, in summary, as you think about it, there's many different ways to look at how you want to fund the growth of your business, depending on the size of your business, where you are within its current state and where you want it to be in the future. But as you go out and you look for a capital raise, there's sort of three big things you think about. One, make sure you understand what you're looking for in an investor beyond cash. We sort of quickly talked about all those different components up front, but those are some of the things you're really going to want to think about as you go out, both for your business, align a vision for your employees, for the overall company. Also have realistic expectations and huge ambitions. When you look at financial investors, you look at strategics, you're putting a forecast out there that people are going to invest behind. Make sure that you can hit that, because it will be very uncomfortable if you don't. But also have huge ambitions to continue to grow your brand. It got you where you are today, and it's going to continue to drive you and your business forward. And then the last one is, remember, you're going to be raising multiple times. So make sure that you think about the amount of money you're getting, how much equity you're giving away, and the value of your company, because you're going to have to go back out, and you don't want to be left after 10 years of hard work with a very small percentage of the business.